I think we're onwards to 120. I mean, this is uncharted territory, at least going back a while. You're talking about 80s rock, I think, and it was 1985. We were going to see Back to the Future, weren't we, when cable was last at this level. So, you know, we're having to go back very far to find, if you like, technical levels of support. And I think ultimately this is just a grind lower in sterling. It is a balance of payment story.
So dive into that a bit more for us, because clearly over the weekend the headline was just that we've got the Brexit timeline date set, but there's more details to this, current account deficits and the like.
Well, look, the underlying story is the UK runs a substantial current account deficit. It's going to remain under pressure despite weaker sterling, because a number of the elements are quite sterling insensitive, and also you've got the financial services surplus, which is now under threat. And that's the underlying theme. Do you get enough capital coming into the UK to, if you like, finance that deficit, to put it simply? What you get occasionally, though, is what we had at the weekend. That story is then punctuated with additional negative news. The idea that we are almost certain to trigger Article 50 by the end of the first quarter. And most of the rhetoric we're getting from the UK points towards a harder format of Brexit rather than some of the soft ones that maybe people in the market had hoped for.
Daragh, I was just reading this morning that the UK has become the second most popular country in the world for inbound M&A, surpassing Switzerland. Is that really all because of the currency?
Well, that helps, isn't it? Because essentially what you're trying to say is we want to make the UK more attractive to your capital, despite the fact that you've got this growing uncertainty regarding our relationship with the EU. And how do you do it? Well, you say, I'll offer it a little bit cheaper today than I did yesterday. And, oh, is that not enough to get you in? OK, I tell you what, tomorrow I'll offer it even cheaper. And so that is exactly what the exchange rate's meant to do.
But at some point, could the massive depreciation in the pound actually not be good for the UK companies?
I think it's about pace. You know, if we get a reasonably orderly decline in sterling and it's not undermining, if you like, the value of those assets in foreign investors' eyes, then it's helpful. But if you get a sudden decline and it feels like it's spiraling out of control, then you're right, it absolutely changes the dynamic.
But those levels you're suggesting, 120 by the end of this year, 110 by the end of that next year, that does feel like it's somewhat of a spiral. You know, this is a major currency pair. It's not a penny stock.
You're just spoiled. That's the problem. We're spoiled on sterling because it's been relatively stable. You could forecast 150, 160 most years. You got it right. You know, you think of something like euro dollar. We went from 140 to 105, and the consensus then was we're going to go through parity and onwards. So, you know, currencies can do big moves, and 120, 110, to me, it doesn't actually sound that outlandish. It's a necessary adjustment.
And if we just quickly round things off, obviously the IMF upgraded GDP forecast for this year, but downgraded quite significantly for next year. Is that fair? Are we going to hit sort of 1% GDP next year? We've
had better numbers. We're slightly sub 1% on that. We've had better numbers certainly for the third quarter, so that raises questions over whether the Bank of England needs to ease further in November. But, you know, the real story for the UK economy is going to be what happens next year. Investment intentions are much lower. That's where the squeeze comes. So I think we're still in for a pretty weak 2017.
Hey CNBC fans, thanks for checking out our YouTube channel. Here you're going to find videos packed with all of the information that you need to be smarter about your finances. You can subscribe by clicking right here and click on all the videos around me or the eye right here to watch the latest from CNBC. Thanks for watching.